We have Surabhi, the S&P Global Insights guest with us.
Yes, absolutely. Crude oil dominating the headlines considering the developments in West Asia. So let's discuss this with Zhuwei Wang, who's Director of Research and Analysis at S&P Global. Thanks so much for joining in. I really hope I got the pronunciation of the name right. But what's your sense, given what we've seen? I mean, till now, there is no talk of negotiation or de-escalation. But there's also no clear commentary on whether Iran is going to try and choke off the Strait in any way, the Strait of Hormuz. So what about your opening thoughts, Zhuwei? How have you looked at the last 3 days of developments?
Thanks for having me. By the way, you are pronouncing my name in the right way. So absolutely, in the last Friday, we saw the oil prices spike by more than 7%. And even today, I think we saw all the high opening of oil prices before gradually going down a little bit. I think the two key messages from S&P Commodity Insights. The first one, I think, is more, yes, all of the tensions between Israel and Iran will definitely cause potential market concern about the disruptions of the oil supply. But so far, the target from by Israel targeting Iran is more focused on, number one, military, number two, nuclear facilities. And there's no deliberate tensions from Israel to target the oil infrastructure or the trade flows, not to mention the trade through the Strait of Hormuz. And number two is also very important, right? So over the weekend, we saw a lot of the fire exchange targeting for example, the refineries in Tehran refinery and also the gas treatment facilities in the South part in Iran. But all of that is more constrained within the domestic market of supply-demand balances. It is still not being impacting the exporting market so far.
So would you say that if the conflict remains in the boundaries of what we've seen, that there's no move to have some sort of an oil embargo at the Strait of Hormuz, and if it doesn't target any further refineries or any other specific oil storage capacity, then do you think the market has seen the worst of the price shock?
I think so far, based on the mass market reaction, the answer is yes. So first of all, if you're just looking at the history, the Strait of Hormuz actually has never been closed. Even during the Iran and Iraq wars in 1980s, actually it hasn't been never closed. And number two, for example, right, so if really Iran triggers some attacks targeting those vessels transiting through the Strait of Hormuz, we're actually not talking about only 1.2 million barrels per day of crude oil exports solely coming from Iran. We're actually talking about more than 20 million barrels per day of crude oil and refined product supply to the entire world. And that will drag the Iran into the tensions, not only between Israel, but also between the other Middle East oil producers. And we think that is something that Iran definitely cannot afford to.
Let's get to a couple of levels then. The worst case scenario, where do you see crude oil prices move? Because, even with the geopolitical tensions, it's not yet got past the high that we saw on Friday, which was around $78 per barrel mark. Where do you see it headed? Because as it is, there was a supply issue. The OPEC has it in their power as well to pump a little bit more crude into the market. So best case and worst case scenario, where do you see crude oil prices move to?
So first of all, for the extreme bullishness, right? So if we say in the next coming days or weeks, if there's major disruptions for only Iranian crude oil export and infrastructures, and we're talking about at least 1.5 million barrels per day of crude oil exports coming out of Iran, we will likely be paralyzed in that kind of extreme scenario. Then next year, we will see the dated Brent will likely ramp up standing above $70 per barrel at least. But we think that is very unlikely. And in the relatively bearishness scenario, I think so far, which is our base case, we think that the current tensions between the two sides to the oil fundamentals will likely be very short-lived. After summer, when the crude oil burn is finished, when the refinery spike up is finished, we think gradually the oil market spike prices will be turning into a bearish mode, leading to the crude oil inventories. And then given that additional barrels pushed out by the OPEC Plus in coming rounds of negotiations and monthly meetings, we think the dated Brent prices will likely be stay and reach to around 50s by the end of this year.
Oh, oil prices Brent around 50s by the end of this year.
Yes.
Well, we won't complain as an oil importer. Major oil consumer India definitely won't complain with $50 a barrel. Zhuwei, before we let you go, do you look at gold as well? Because obviously this entire geopolitical situation, it led to an upward bid. Any thoughts there?
For gold, for the moment, I'm more focused on the crude oil market, but I do see the spike in prices of gold in past days because of risk assessment in the market.
Okay, all right, got that point. Thank you very much. Good perspective. It's good to get that context that beyond the immediate geopolitical headlines, you're saying that demand supply in the crude oil market is very, very comfortable, and at least S&P sees crude oil prices heading lower by the end of the year.